Nobody has to tell you. Not the bank, not Social Security, not the IRS. You have to know the line, and in this video, I'll show you how to find yours, to the dollar. In the next few minutes, I'm going to show you three things. First, the three kinds of money the IRS counts against you that almost nobody expects, including interest you never touched, and one kind of income that's supposed to be tax-free. Second, later in this video, I'm going to show you a single checkbox that erases your threshold entirely, drops it to 0. If you're married, you especially cannot miss it. And third, at the very end, the exact sentence to say to your bank, word for word, and the one government form that makes sure April never ambushes you again. Nothing here needs a lawyer, an advisor, or a fee, just knowledge and one phone call. Right now, you may be thinking one of four things. Let me save you the trouble. 1. I'm not rich, this isn't me. The line is $25,000, and half your Social Security counts toward it. The average check in 2026 is about $2,071 a month. Half of that gets you most of the way to the line before your savings earns a dime. 2. My bank would have said something. The bank did say something to the IRS. It's called Form 1099-INT, and it reports your interest automatically every year. Telling you what that does to your Social Security is nobody's job, so nobody does it. 3. I heard the new law ended taxes on Social Security. It did not. It added a deduction, a good one, I'll show you how to grab it. But the worksheet that taxes your benefits was not changed by 1 comma. 4. Too late, I already own the CDs. It is not too late. There are 2 fixes that still work this year, and they're both in this video. And if you think I'm exaggerating, the Congressional Research Service, Congress's own research arm, reports that about half of all Social Security beneficiaries now pay federal income tax on part of their benefits. When this started in 1984, it was supposed to touch about 1 in 10, half. That drift wasn't an accident. Stay with me and I'll show you the machine that did it. Pen and paper out. This is the whole machine, and it's 3 lines long. The IRS adds up what it calls your combined income. Line 1, your other income, pension, IRA withdrawals, and yes, every dollar of bank interest. Line 2, your tax-exempt interest. Write that down and circle it. The tax-free municipal bond interest your broker sold you, it gets added back in. On this worksheet, tax-free counts. Line 3, 1/2 of your Social Security benefits. Add those 3 lines. If you're single and the total passes $25,000, part of your benefits becomes taxable. Past $34,000, up to 85% of them can be. Married, filing jointly, the lines are $32,000 and $44,000. Now the part almost nobody knows. Those lines were set in 1983 and 1993. They have never been adjusted for inflation, not once in over 40 years. Your benefits get a cost of living raise, 2.8% this year. The lines don't move. Every raise walks you closer to a line that was drawn when gas was $1 a gallon. They know. They are not required to fix it, so they don't. Let me show you what this does with real numbers. Math on screen. Ruth, single, 69. Social Security, $24,000 a year. Half counts, that's $12,000. Small pension, $20,000. And $45,000 in CDs at 4%. $1,800 of interest. Her combined income, $33,800. That $1,800 of interest doesn't just get taxed itself. In her range, generally every dollar over the line drags 50 cents of her benefits onto the return. So her $1,800 of interest puts roughly $900 more of her own Social Security on the tax return. $2,700 of taxable income from $1,800 of earnings. In the 12% bracket, that's about $324 of tax. On a 4% CD, that's an effective tax of 18%. Her dollar, taxed coming and going. Now Earl and Dot, married, $42,000 a year in benefits. Half is $21,000. $25,000 from IRA withdrawals, and $155,000 in savings at 4%, $6,200 of interest. Combined income, $52,200. That's past $44,000, the upper line, the 85% zone. Up here, generally every dollar of interest drags 85 cents of benefits with it. Their $6,200 of interest becomes $11,470 of taxable income. In the 22% bracket, $2,523. That is 40.7 cents of tax on every dollar their savings earned. There's your title. Taxed twice isn't a figure of speech. It's the worksheet doing exactly what it was built to do. Write this down because here's the trap inside the trap. This applies to CD interest you never withdrew. On most CDs longer than 1 year, the interest is generally reported to the IRS every year whether you touch it or not. The money sat still, the tax bill didn't. So how much is too much to keep in savings? Here's your personal line, and it's one division problem. Take your threshold, 25,000 single, 32 married. Subtract half your Social Security. Subtract your pension and withdrawals. Whatever room is left, divide by your interest rate. At 4%, every $25,000 of savings throws off $1,000 of counted income. If you've got $5,000 of room, your savings line is around $125,000. If you've got no room left, every new CD dollar may be earning at 40 cents on the dollar against you. Single and thinking my numbers are smaller than Ruth's? Don't go anywhere. The next part is about the people the worksheet hits hardest, and it might be you. Quick checklist. You're in the crosshairs if you're a widow or widower filing single. Your threshold dropped from $32,000 to $25,000 the year after you lost your spouse, while your expenses didn't drop with it. You took your first IRA withdrawal this year. You finally moved money out of a checking account into a CD that actually pays. Or your tax-free bonds pay you interest every month. Any one of those can shove you over a line you never knew existed. 3 myths keep people from looking. Let's break them. Myth 1. Shame. If I owe, I must have filed something wrong. You filed fine. The line was frozen in 1983 so that inflation would do the catching. Not your guilt, not your pride, and not your math. Myth 2. Fear. If I move my savings, the IRS will flag me. Moving your own insured deposits between banks is generally not a taxable event and not a red flag. It's your money. They hold it, you direct it. Myth 3. Pride. I've done my own taxes for 50 years. I'd have seen it. The Social Security Benefits Worksheet is around 18 lines, buried in IRS Publication 915. It was not written to be seen. It was written to be correct. Quick case. Helen, 75, widowed, Tucson. Her advisor put her in municipal bonds. Tax-free, Helen. $6,000 a year of muni interest. On the worksheet, all $6,000 counts. It pushed about $3,000 of her benefits into taxable territory, roughly $36 a month every month for owning the tax-free investment. The brochure never mentioned the worksheet. The brochure was never going to mention the worksheet. Now the upgrade twist. The good news, they also won't mail you. For tax years 2025 through 2028, there's a new deduction, up to $6,000 per person 65 or older, $12,000 for a qualifying couple, on top of your regular standard deduction. You claim it on Schedule 1A. For many middle-income retirees, it can wipe out the very bill this worksheet creates. The honest footnotes. It generally phases out above $75,000 of income single, $150,000 married, and it expires after 2028, 4 tax years. The letter telling you to claim it does not exist. It was never going to exist. Still with me? Good, because knowing the machine is worth nothing until you run your own numbers. That's the next 5 minutes. 3 steps, tonight. Step 1. Pull last year's tax return and every 1099 INT the bank sent you. Run the 3 lines, other income plus tax-exempt interest plus half your Social Security. Compare it to your line, 25 or 32,000. Now you know exactly where you stand, which is more than anyone was ever going to tell you. Step 2. Call your bank. Ask for every account under your Social Security number, every CD renewal date, and the exact interest they'll report this year. Here's the stakes line. Every CD you let auto-renew is a vote to repeat this year's tax bill next year. Check first, renew second. Step 3. Pick your shield. If you'll owe, Form W-4V lets Social Security withhold tax from your monthly check.
7, 10, 12, or 22%, your choice, so April stops being an ambush and there's generally no underpayment penalty nipping at you. And when you file, claim that $6,000 deduction on Schedule 1A. Both forms are free, both take minutes. If the worksheet or the forms feel like a wall, ask a son, daughter, or grandkid to sit with you. It's a great 15-minute favor, and it might be worth a few $100s a year. Do those 3 steps and you're ahead of roughly half the country. But before you touch that tax return, remember I said about the $0 checkbox? We're there. And if you're married, do not file anything until you hear this. Everything I've told you assumed your line is $25,000 or $32,000. There's one group whose line is 0. Married filing separately, and you lived with your spouse at any point during the year. For you, the threshold isn't lowered, it's erased. Generally, up to 85% of your benefits can be taxable from the very first dollar of income. Not a phase-in, a trapdoor. Some couples file separately to keep finances tidy, separate returns, same kitchen table, and the IRS decides your tax-free allowance is $0.00. Romance, it turns out, is not deductible. Nobody broke a law here, you'd just be paying for not knowing theirs. One checkbox, filed in good faith, can cost a couple more than this entire video's worth of CDs would earn. If separate filing was ever suggested to you, that worksheet is the first thing to check, before the box gets ticked. Now, the part you've been waiting for, the exact words, pen and paper out. 2 calls. Call 1 is your bank. The number is on the back of your bank card or the top of your statement. Call mid-morning, Tuesday through Thursday, when the lines are shortest. Line 1. Force the full picture. Please read me every account under my Social Security number and the exact amount of interest you will report to the IRS on Form 1099 INT this year, including CDs that have not matured. Line 2. The strategy sentence. These are the magic words. On any CD with a term of 1 year or less, I want the interest credited at maturity, so I choose which tax year it lands in. Honest footnote. On CDs longer than 1 year, the interest generally must be reported annually no matter what. That's their rule, and it's printed in the deposit agreement they'll happily never read to you. The timing move works on the short ones, and short CDs are paying nearly the same as long ones right now. Line 3. Looking backward. If I missed a deduction or over-reported, I'll file Form 1040X. That's the amended return. You can generally go back 3 years. If you skipped the senior deduction or paid tax on benefits you didn't owe, that's your money, and the refund request is yours to make because no one is coming to make it for you. The defense line. If the rep says, "I can't see that," or "That's not something we do," don't argue. Say, "Then please transfer me to deposit operations or mail me my deposit agreement and a year-to-date interest summary. I'll hold." The rep reads from their script. This script is yours. Line 4. Always. Send me that in writing, paper or secure message, before anything renews. Call 2 if you want withholding from your Social Security check, Form W4V. Download it at irs.gov or call Social Security at 1-800-772-1213. Best time? First thing in the morning, midweek, late in the month. And one rule for both calls. If an answer feels off, hang up politely, call again. 2 matching answers, then proceed. 3 mistakes to never make again. 1. Letting CDs auto-renew blind. Every blind renewal reorders this year's tax bill. 2. Buying tax-free bonds to beat a worksheet that counts them anyway. 3. Skipping a $6,000 deduction because no letter came. The letter was never coming. Remember Frank? Here's the ending I didn't tell you. The $1,400 from last year, gone. It was legally owed and no phone call brings it back. That's the honest part. But this year, Frank ran the 3-line math with his granddaughter at the kitchen table. He claimed the $6,000 deduction. His bill dropped to nearly nothing. He filed the W4V so there's no April surprise left to spring. And he broke that $155,000 CD ladder into pieces with maturity dates he picked, on purpose,
with the interest landing in years he chose. Same bank, same savings, same Social Security. The difference wasn't luck, a lawyer, or a loophole. It was 15 minutes of knowing what to ask. Tonight, the tax return, the 1099s, 3 lines of arithmetic. That's it. Then send this video to one person you know with a CD and a Social Security check. A widowed sister, a friend, an old coworker, the neighbor who just bragged about his new rate. You won't be sending a video. You'll be handing them a few $100s a year every year. And when you make your call, comment the word worksheet below. I read every one. See you in the next video. If you answer yes to even one of these 6 questions, your Social Security check could shrink starting this year, and most people watching right now have no idea any of these rules exist. You don't need to answer yes to all 6. One is enough. Stay with me because question 4 is the one almost nobody knows about until the letter shows up. Let's start with a viral news report about Kara Kendall. Kara Kendall lives in Miami Township, Ohio. She received a Social Security overpayment notice tied to her disability benefits, demanding she pay back more than $17,000. She told a local news investigative team she went into full panic when the letter arrived. When asked if she'd ever figured out what actually caused the overpayment, she said no. The Social Security Administration never explained it to her. They just sent the bill. That case was reported by an investigative news team in Ohio, and it's one of thousands like it that surfaced after the SSA's overpayment policy changed twice in 2 years. Kara didn't do anything wrong. She just got caught in a system that often can't explain its own mistakes before it demands the money back. Keep that story in mind, because question 2 is exactly what happened to her. Question 1. Are you collecting Social Security before your full retirement age and still working a job? According to the Social Security Administration's 2026 fact sheet, if you won't reach full retirement age this year, the SSA withholds $1 in benefits for every $2 you earn above $24,480 annually. If you will reach full retirement age sometime in 2026, that threshold jumps to $65,160, and the withholding rate drops to $1 for every 3. Here's what that looks like in real numbers. A 64-year-old who claimed early and takes a part-time job paying $50,000 a year is $25,520 over the limit. That triggers $12,760 in withheld benefits for the year, according to a 2026 SSA earnings test breakdown. For someone collecting $1,920 a month, that is over half their annual benefit gone. Now picture someone closer to full retirement age, earning $70,000 in the months before their birthday. They're $4,840 over the higher threshold, which works out to $1,600 withheld for the year, a much smaller hit because the rules get more forgiving the closer you are to full retirement age. The reassuring part the SSA doesn't advertise loudly enough is that this money isn't lost forever. Once you hit full retirement age, your benefit gets recalculated to credit you for every month that was withheld, so you do get most of it back over time, just not on the schedule you were expecting. If this applies to you, the fix is simple. Call the SSA at 1-800-77-21213 and tell them your estimated earnings for the year before you start collecting, so they can withhold gradually instead of hitting you with a surprise bill after the fact. Question 2. Have you ever received an overpayment notice from the SSA, even one you thought was resolved? This is the one that changed twice in just the past year, and most people watching haven't kept up with which version is currently active. In March of 2024, the prior administration capped default withholding at 10% of your monthly benefit after years of reporting on people losing their entire checks. In March of 2025, that policy was reversed, and the SSA briefly moved to withholding 100% of benefits until the overpayment was repaid, affecting hundreds of thousands of people according to Kaiser Family Foundation reporting at the time. After public backlash, the SSA settled on the rate active right now, 50% of your monthly retirement benefit or 10% of SSI withheld automatically starting roughly 90 days after the notice if you don't take action. Here's a number that matters more than people realize. The SSA's own Inspector General found that 73,000 overpayments in a single recent year were caused by the agency's own calculation errors, not by anything the beneficiary did wrong. If you got hit with one of these notices, you have three real options, and most people only know about one of them. You can file Form SSA 561 to request reconsideration if you think the overpayment determination itself was wrong. You can file Form SSA 634 to request a lower monthly repayment rate if 50% would create financial hardship. Or you can file Form SSA 632-BK to request a full waiver if the overpayment genuinely wasn't your fault and you can't afford to repay it. While any of those requests are pending, the SSA is supposed to pause withholding, which means filing fast matters more than filing perfectly. This channel exists to track exactly these kinds of changes the week they happen, because the rules move faster than most people can keep up with on their own. If that's useful to you, subscribe now so you don't miss the next one. And let's keep going, because the next question affects almost nobody you'd expect. Question 3. Did you get married, divorced, or change who you're living with in the past year while receiving SSI? Marriage triggers something called spousal deeming, where part of your new spouse's income gets counted against your SSI eligibility, even though it's not your money. According to the SSA's 2026 SSI rules, the maximum individual benefit this year is $994 a month, and the maximum for a couple is $1,491. If your spouse's countable monthly income after deductions comes in above roughly $497, the SSA starts treating you as a couple for benefit purposes, which can shrink your payment significantly or eliminate it outright. The flip side almost nobody mentions. Getting divorced can actually increase your SSI payment because your household income just dropped on paper. The SSA also applies a $3,000 combined resource limit to married couples, even when only one spouse is SSI eligible, which catches people off guard when a new spouse's savings account gets folded into the calculation. Either way, any change in marital status has to be reported to the SSA within 10 days after the end of the month it happened in, and missing that window is how a lot of these cases turn into overpayment notices down the road. Question 4. Is a family member or roommate helping cover your rent, your utilities, or your groceries while you're on SSI? This is officially called in-kind support and maintenance, and it is the rule almost nobody knows about until their check comes in smaller than expected. According to SSA guidance for 2026, if someone else is paying part of your housing or food costs, the agency can reduce your SSI payment by as much as $351.33 a month, depending on how much support you're receiving and how it's documented. The part that catches people off guard is that this applies even to well-meaning help from your own adult children or a roommate splitting bills informally. There is one notable exception worth knowing. If everyone in your household receives a public assistance benefit like SSI, TANF, or SNAP, the SSA generally doesn't evaluate in-kind support from other household members at all, on the assumption that everyone in that home needs their own income to get by. If you're not sure whether your living situation qualifies for that exception, that's worth asking the SSA directly rather than guessing and risking an incorrect reduction. Question 5. Do you have more than $2,000 in countable resources as an individual or $3,000 as a couple while receiving SSI? This limit has not been adjusted since 1989. If it had simply kept pace with inflation, it would be sitting above $5,000 today. Instead, it's frozen exactly where it was almost 4 decades ago, which means a modest savings cushion that felt completely safe a decade ago can now put you over the line without you realizing it. The SSA evaluates your resources on the first day of every month, so even a large tax refund or a holiday cash gift that lands in your account at the wrong moment can temporarily disqualify you. Certain things don't count toward this limit, like your primary home and one vehicle, But a second small savings account, an old life insurance policy with a combined face value over $1,500, or retirement accounts you're able to access can all push someone over without warning. If you're trying to save beyond that limit without losing SSI, there's a legitimate tool for it, an ABLE account. As of 2026, anyone whose disability began before age 46 can open one, and the first $100,000 held in that account is completely excluded from the SSI resource count. That's one of the only legal ways to build real savings while staying eligible. Question 6. Did you forget to report a change to the SSA within the required window, whether it was income, an address, a marital status change, or a living arrangement? According to SSA reporting rules, most changes need to be reported within 10 days after the end of the month they occurred in. Missing that window is one of the most common ways an overpayment notice gets generated in the first place, which loops you straight back to question 2 and the 50% withholding rate that's active right now. The good news is that reporting a change is usually fast. You can do it through your online My Social Security account by calling 1-800-772-1213 or in person at your local field office, and getting ahead of a change before the SSA catches it themselves is almost always easier than untangling an overpayment after the fact. So here's the summary. 6 questions, and you only needed one yes to be at risk this year. Working before full retirement age can trigger the earnings test and withhold over half your annual benefit depending on how much you earn. An old overpayment notice, even one caused entirely by the SSA's own error, like what happened to Kara Kendall in Ohio, could mean 50% of your check is being withheld right now under the current rate. A marriage or living change can trigger spousal deeming on SSI and shrink or wipe out your payment. Help from family with rent or groceries can quietly reduce your SSI payment by over $350 a month, unless your household qualifies for the public assistance exception. A resource limit frozen since 1989 can disqualify people who think they're still safely under it, though an ABLE account can legally protect up to $100,000 from that count. And missing a 10-day reporting window can create the very overpayment that costs you the most. None of these are theoretical. They are the current active rules as of 2026, and the SSA is not going to call you to walk you through which ones apply to your situation. Send this video to someone you know who's on Social Security or SSI right now, because the odds are good that at least one of these 6 questions applies to them, and they have no idea. The Social Security Administration processes your Medicare premium automatically. They calculate your surcharge automatically. They record your earnings automatically. Not one of those 3 automatic processes has a built-in step that flags when the number is wrong and suggests you call to fix it, because fixing it costs the system money. The system was not designed to cost itself money on your behalf. That is why these 3 calls exist, and that is why nobody at SSA will ever be the one to suggest them. Right now, in 2026, an estimated 7.5 million Medicare recipients qualify for a program that eliminates their Part B premium entirely and pays their deductibles and copays on top of that. Most have never heard it exists. The Medicare card in their wallet gives no indication they are overpaying. The agency processing their premium has no financial reason to tell them. On top of that, Social Security earnings records contain errors at a rate the agency has acknowledged for decades. Each incorrect year reduces a monthly benefit by approximately $100 permanently. The record sits online for anyone to check. Most people never do. And a Medicare surcharge that millions of retirees are paying right now is based on income from 2 years ago that no longer exists. Income they earned before they retired, before a spouse passed away, before a one-time property sale. The surcharge is automatic. The appeal is optional. SSA processes it without explanation and waits for you to ask why. 3 phone calls fix all 3. One afternoon. No lawyer. No paperwork beyond what you already have at home. In this video, I'm going to walk you through each one. The number to dial, the exact words to say, and the dollar amounts these calls have returned to retirees who made them. Stay through call 3. SSA has the least incentive of all to tell you about that one. Before the first call, I want to tell you about a 69-year-old retired nurse in Memphis named Margaret. Margaret had been on Medicare for 4 years and collecting Social Security for 3. She paid her $185 Part B premium every month without question. She paid her annual deductible. She paid her co-pays every time she went to the doctor, which at 69, with a replaced knee and a thyroid condition she was managing, was often. She had built her retirement budget around those numbers the same way she had built her working life around her income, carefully, without complaint. Last fall, Margaret was sitting in her doctor's waiting room when the woman next to her mentioned she had not paid a Medicare premium in 2 years. Margaret assumed the woman had a different kind of coverage. She asked. The woman told her about something called the Medicare Savings Program and gave her the number for the state Medicaid office. Margaret went to her car. She sat in the parking lot and did the math on her phone. $185 a month for 48 months. She had paid $8,880 in premiums, plus deductibles, plus co-pays, on a program that was supposed to cover all of it if her income fell within a certain range. Her income fell within the range. It had fallen within the range since the day she enrolled. She drove home and made 3 phone calls that week. By the time her next Social Security statement arrived, her monthly income was $570 higher, permanently, every month, for the rest of her retirement. Not from a lawsuit, not from a government program that opened up, from 3 calls that took less than 2 hours combined. Calls she could have made the day she turned 65. Calls nobody told her to make. Here is the structure underneath all of it. 3 separate government systems that were never designed to talk to each other and have no obligation to start. Medicare is run by the Centers for Medicare and Medicaid Services. The Medicare Savings Program that eliminates your premium is administered by your state Medicaid office. Those are 2 separate agencies. They operate separate databases. Medicare does not flag your account and alert your state office that you might qualify. Your state office does not scan Medicare enrollment records looking for eligible applicants. The Medicare Savings Program was created by Congress in 1988. It was specifically designed to help low-income seniors cover their Medicare costs. In the 38 years since it was created, enrollment outreach was never funded at the federal level. The assumption was that state Medicaid offices would find their own eligible seniors. Most states have never had the staffing or budget to do that systematically. So the program sits there, $2,500 to $6,000 a year per qualifying senior. And the people it was designed to help pay their premiums every month without knowing they could apply. Your bank profits when you keep money in an account. Your Medicare plan profits when you pay your premium. Neither has a financial incentive to tell you about a program that eliminates what they collect from you. So the conversation never starts. And Social Security is a 3rd separate system entirely. Your earnings record, your benefit calculation, and your IRMAA surcharge all sit in the SSA database. None of it cross-references automatically against Medicare eligibility or state Medicaid records. 3 agencies, 3 databases, no bridge between them. 1 retiree sitting at home paying 3 separate bills that could have been lower or zero. Phone call number 1. The call SSA has no system to suggest and no incentive to start. This call is to Social Security. The number is 1-800-772-1213. When an agent answers, say this exactly. I want to request my complete earnings history and verify my record for any discrepancies year by year. Your Social Security benefit is calculated using your 35 highest earning years. Every year of earnings on your record came from a payroll report submitted by your employer. Before the year 2000, the majority of that processing was done manually. Employers submitted paper forms. SSA clerks entered the data. Numbers got transposed. Entire years got skipped. Part-year employment at companies that closed before filing their final reports never made it into the system. An IRS and SSA joint review found that approximately 3.3% of all Social Security wage entries contain errors. Applied to 70 million active beneficiaries, That is over 2 million people collecting less per month than they earned.
Each incorrect year reduces your monthly benefit by approximately $100. On a 20-year retirement, one missing year of earnings costs you $24,000. 3 missing years cost $72,000. The correction is free. The documentation is a W-2, an old tax return, or a pay stub from the year in question. Documents that are easy to locate right now and harder to find the longer you wait. You can review your earnings history before you call by logging into ssa.gov and opening your My Social Security account. Pull up your statement. Compare the earnings listed for every year of your working life against whatever records you have. Any year that is blank or shows a number significantly lower than what you remember earning is worth a call. Margaret found 1 year missing entirely, 1994. 8 months at a printing company that closed the following year. The company's final payroll submission was never processed. One correction added $87 to her monthly benefit, permanent. She will collect that $87 extra every single month for the rest of her life. A 72-year-old retired steelworker in Pittsburgh named Frank found 2 years missing, 1981 and 1983. His mill had switched payroll processing systems, and the transition records were never submitted correctly to SSA. Frank had no idea. He had been collecting Social Security for 7 years when he made this call. The correction added $180 per month to his benefit. He asked about retroactive payment for the years he had been underpaid. SSA processed a 6-month retroactive lump sum, $1,080 deposited within 4 weeks. Phone call number 2. This one does not even go to SSA, and that gap between agencies is exactly why 7.5 million eligible seniors have never made it.
This call is to your state Medicaid office. To find the number for your state, call 1-800-MEDICARE. That is 1-800-633-4227, and ask them to connect you with your state's Medicare Savings Program office. When someone answers, say this: I want to apply for the Medicare Savings Program and find out which tier I qualify for. The Medicare Savings Program has 3 tiers. Each one eliminates a different portion of your Medicare costs. The income thresholds are higher than most people expect. The first tier is QMB, Qualified Medicare Beneficiary. Monthly income under $1,350 as a single person or $1,824 as a married couple. QMB covers your Part B premium completely. It covers your Part A premium if you pay one. It covers your annual deductible. It covers every copay and every co-insurance charge on every Medicare-covered service you receive. Nothing out of pocket. The state pays it directly to Medicare on your behalf. Annual savings range from $2,500 to $6,000 depending on how much Medicare-covered care you use in a year. QMB also does something most people do not know. Any provider who bills a QMB recipient directly for a Medicare-covered service is violating federal law. If a doctor's office sends you a bill for a copay you do not legally owe, you have the right to report that billing to Medicare, and the provider can face penalties. The protection is real, and it is enforced. The second tier is SLMB, Specified Low-Income Medicare Beneficiary. Income up to $1,616 per month single or $2,184 married. SLMB covers your Part B premium. That is $202.90 every month eliminated, $2,434.80 per year returned to your income. The third tier is QI, Qualifying Individual. Income up to $1,816 per month single or $2,455 married. Also covers your Part B premium completely. QI funding is first come, first served for the year. Applications submitted earlier in the calendar year are processed before funding runs out. If you are within the QI income range, file as early in the year as possible. The Part B premium in 2026 is $202.90. It increased nearly 10% from last year. That increase consumed more than a quarter of Social Security's entire cost of living adjustment for 2026. If your income puts you within any of those 3 thresholds and you have not applied for the Medicare Savings Program, you paid that increase on a bill the state was supposed to be paying. The application is one form. Filed through your state Medicaid office. Takes about 15 minutes to complete. Margaret's total monthly income from Social Security and a small pension was $1,580. That put her above the QMB threshold but inside the SLMB range. Her $200 and 2.90 Part B premium was eliminated the month her enrollment processed. $2,434.80 per year back in her account, every year. A 74-year-old retired letter carrier in Albuquerque named Robert had a different outcome. His income came in just under the QMB threshold at $1,290 per month. His enrollment in QMB eliminated not just his $202.90 premium, but his annual Part B deductible of $283 and every copay on every doctor visit and lab test he had for the year. Robert had been paying roughly $180 in copays per month on average due to ongoing treatment for diabetes and high blood pressure. His total annual savings came to just under $4,600. One form, filed through the state Medicaid office. The same office Robert had driven past for 11 years on his mail route without knowing it processed applications that could have helped him every single year since he enrolled in Medicare. Phone call number 3. This is the one SSA profits from you never making. Every month you do not make this call is a month the surcharge keeps running. This call is back to Social Security. Same number, 1-800-772-1213. When an agent answers, say this: I want to request the SSA 44 form to appeal my IRMAA surcharge based on a qualifying change in my income. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge added to your Part B premium when your income from 2 years ago exceeded certain thresholds. In 2026, those surcharges add $81.20 to $487 per month on top of the standard $202.90 premium. The highest income tier pays $689.90, $189.90 total for Part B alone. The surcharge is calculated automatically using your most recent available tax return. Your 2026 surcharge is based on your 2024 income. If something changed between 2024 and today, the surcharge has not changed with it. It is still running on the old number. Here is who that catches without warning. You retired at the end of 2023 or in 2024. That final working year included a full salary. Your tax return showed higher income than your retirement income will ever show again. Medicare looked at that return and set your 2026 premium accordingly. You are now living on Social Security and savings and still paying a surcharge calculated as if you are working. A spouse passed away. Your filing status changed from married to single. Your household income dropped significantly. The surcharge did not adjust. You sold a property or a business in 2023 or 2024. One-time income, never recurring. The transaction pushed your tax return into a higher bracket for that single year. Medicare picked up that number and has been charging you for it every month since. The SSA 44 form exists specifically for situations like these: retirement, death of a spouse, divorce, reduction in work hours, loss of a pension. Any qualifying life-changing event allows you to document your current income, file the form, and have your surcharge recalculated based on what you earn now rather than what you earned 2 years ago. A 67-year-old retired teacher in Phoenix named Helen sold an investment property in 2022 for a significant gain. Her 2022 tax return reflected income far above what she earned from teaching or would earn in retirement. Her 2024 Medicare premium was hit with a $487 monthly IRMA surcharge. She filed the SSA 44 with documentation of her current retirement income. The surcharge was eliminated entirely. $5,844 per year returned. Margaret filed the SSA 44 for a property her late husband had sold 2 years before he passed. That one-time sale had inflated their final joint tax return. She had been paying a $298 monthly surcharge in 2026 based entirely on income that had not existed for 2 years. The SSA 44 removed it. $3,576 per year back in her account. Here is the late reframe, and this is the one worth writing down. The Part B premium went from $185 in 2025 to $200 and 2.90 in 2026, a 10% zero in 2026, a 10% increase in 1 year. Social Security's COLA for 2026 was 2.5%. That means before any retiree spent a single dollar on groceries, utilities, or medication, more than a quarter of their raise was already gone to the Medicare increase. The raise that was supposed to help them keep up with rising costs went directly to the agency billing them for coverage. The 7.5 million seniors who qualify for the Medicare Savings Program paid that full increase on a bill the state was supposed to be paying. The retirees paying IRMAA surcharges on income they no longer earn paid their surcharge increase too. The retirees with errors in their earnings records collected their reduced benefit for another year without knowing the correction was available. All three categories, all three bills, all still running in the background, because no agency has the obligation or the system to stop them on your behalf. 3 phone calls stops all 3. Here is the full picture. Call 1 to Social Security to verify your earnings record year by year. 1 missing year costs $100 per month for the rest of your retirement. Call 2 to your state Medicaid office to apply for the Medicare Savings Program. Income under $1,816 per month as a single person may qualify you to eliminate the $202.90 Part B premium entirely. Call 3 back to Social Security to request the SSA 44 form if your income drops since the year your IRMAA surcharge was calculated. Retirement, death of a spouse, a one-time property sale, all qualifying events, all reversible with one form. Margaret made all 3 calls. She is collecting $570 more every single month. The calls took less than 2 hours. She made them in 1 week. Send this video to one retiree you know who has never checked their Social Security earnings record or questioned why their Medicare premium is the number it is. That one share might put hundreds back in their account every single month from 3 calls the SSA had every reason in the world to never suggest. That is what this channel is here to do. I will see you in the next. If you were born before 1955, I need you to stop what you are doing right now and stay with me for the next 10 minutes, because there is a very real chance that the Social Security check landing in your account every single month is smaller than what you're actually owed. Not by a little. I am talking about hundreds of dollars a month, potentially thousands of dollars every year, sitting in a government calculation that was done wrong, and nobody from the Social Security Administration is going to pick up the phone and call you to tell you about it. That is not how this system works. The system sends you a number, you accept the number, and the money you were supposed to receive just quietly disappears. Today, I'm going to show you exactly why this happens, how to find out if it happened to you, and the specific steps you take to fix it before another month goes by. Stay until the end. The last step is the one almost nobody takes, and it is the only step that actually moves money from the SSA's system into your account. If you are not subscribed yet, do that right now and turn on the bell. Social Security rules, benefit calculations, and correction procedures change every single year. When they change, nobody from the government explains what it means for your specific situation. That is exactly what this channel does. Subscribe and let's get into it. Before I get into the details, let me tell you about something that happened last year that I think about a lot. A retired mechanic in Tucson named Harold had been collecting Social Security for 9 years. Every month, $1,412 hit his account. He never questioned it. He figured the government knew what they were doing. Then his daughter, who works in accounting, sat down with him one afternoon and pulled up his Social Security earnings statement online. She found it in about 4 minutes. 3 years in the mid-1980s were showing $0 in earned income, even though Harold had worked the whole time. He had his W-2s in a shoebox in the closet. They filed a correction. The SSA confirmed the error. His monthly benefit went up by over $100, and he received a retroactive payment for the month since he had originally filed. Harold's story is not unusual. It is, in fact, far more common than most people realize, and the reason it keeps happening is the same every time. Nobody told him to check. Here is the foundation of everything I'm going to explain today. The Social Security Administration calculates your monthly retirement benefit using your highest 35 years of earnings from your entire working life. They take those 35 years, adjust them for inflation, average them out, and run them through a formula to arrive at what is called your primary insurance amount. That is the number your check is based on. Now, here is where the problem starts. Every dollar in that calculation comes from earnings records that were reported by your employers, often going back to the 1970s, the 1960s, even earlier in some cases. The SSA themselves have acknowledged making approximately $2.5 billion in underpayments in 2022 alone. And according to research published by Social Security Intelligence, nearly half of all earnings record mismatches in the system are never corrected because the people affected never knew to look. If even 1 year of your working life is missing from that record, your benefit is permanently lower. If 2 or 3 years are missing, the gap compounds. One analyst ran the numbers and found that 5 missing years of earnings history can reduce a monthly Social Security check by over $150. Over a 20-year retirement, that is $36,000 gone. Not because you did anything wrong, because nobody told you to open the file. Now let me add the second layer to this, because for people born between 1943 and 1954, there is a specific calculation issue that has quietly cost millions of retirees a significant portion of what they were promised. And it comes down to one date that most people never fully understood. If you were born anywhere between 1943 and 1954, your full retirement age, according to the Social Security Administration, is 66. Not 65, not 67. 66 exactly. That is the age at which you are entitled to 100% of your earned benefit. Here is the problem. The Social Security Administration allowed people to claim as early as age 62, and millions of people did exactly that, especially during years when jobs were uncertain or health was declining. What many of those people were never clearly told is that claiming before your full retirement age does not just give you smaller checks for a few years until the number catches up. It permanently reduces your benefit for the rest of your life. If you claimed at 62 with a full retirement age of 66, your monthly benefit was reduced by 25% permanently on a benefit that should have been $2,000 a month. That is $500 every single month. You will never get back for as long as you live. Last spring, a woman in Columbus named Dorothy posted in a retirement planning forum that she had been getting Social Security for 7 years and only recently learned that her check was 25% smaller than her full benefit because she had claimed early. She said, and I am paraphrasing what she shared publicly, that when she filed at 62, no one at the SSA office sat her down and said, here is what this decision costs you for the rest of your life. She was shown a monthly amount and she signed the paperwork. She said she wished someone had explained it the way a friend finally did 30 minutes over coffee. That story hit a lot of people because it is not an edge case. It is one of the most common financial regrets in the retirement community, and it has a specific shape for people in her birth year range. Now, I want to be direct about something. If you have already been claiming for years and you claimed early, I am not here to make you feel bad. What I am here to do is show you that there may still be money you have not recovered for reasons that have nothing to do with when you filed. Because here is what most people do not know. Even if you claimed at the right time, at 66, at your full retirement age, the check you are receiving right now may still be wrong because the earnings record feeding that calculation may have never been corrected. And that is the fixable part. That is the part the SSA will actually do something about if you bring them the proof. So here's what I want you to do, and this is the part of the video you should be writing down. The first thing is to go to ssa.gov and create or log into your My Social Security account. It takes about 10 minutes if you have never done it before. Once you are in, you're looking for your earnings history, which is a year-by-year record of every dollar that was ever reported to Social Security under your name and your Social Security number. Go through that record carefully. You are specifically looking for any year where the number seems wrong. A year that shows $0 when you know you are working. A year where the income seems far lower than what you were actually earning. A gap anywhere in the timeline of your working life. If you find one, you have found money that was taken out of your benefit calculation without your knowledge. The second step is to gather your documentation. Pull out your old tax returns, your W-2 forms, your pay stubs, anything that shows what you actually earned in the years that look wrong in your record. You do not need to have everything going back 40 years. Start with what you have. Even 2 or 3 years of documentation can be enough to open a correction. The third step is to file Form SSA 7008. That is the official request for correction of earnings record, and it is available directly on the SSA website. You fill it out, attach your documentation, and send it in. You can also do this by calling the SSA at 1-800-772-1213 and asking them to open an earnings record review, or you can go into your local Social Security office in person and bring your paperwork with you. Once you submit the request, the SSA has a process to match your documentation against their records and credit any earnings that were missing. The correction timeline typically runs between 10 and 90 days. If there is a balance owed to you, they will calculate the back pay and issue it as a lump sum direct deposit. Now, here is something important about timing that I do not want you to miss. While the SSA does have some discretion to correct obvious errors, regardless of when they occurred, there is a general guideline that earnings are most easily corrected within 3 years, 3 months, and 15 days from the end of the tax year in which those wages were paid. That means the older the error, the harder it can be to fix, and the more documentation you are going to need. This is not a reason to panic. It is a reason to move on this sooner rather than later. If Harold in Tucson had waited another 5 years to find that shoebox, those 1980s earnings might have been impossible to recover. I also want to address something that comes up every time I cover this topic, which is the question of delayed retirement credits. If you were born between 1943 and 1954 and you delayed claiming beyond your full retirement age of 66, the SSA was supposed to credit your benefit with an 8% increase for every year you waited, up to age 70. That is a potential 32% increase above your full benefit if you waited all the way to 70. The important thing to verify is that those delayed retirement credits were actually applied correctly to your record when you did file. Errors in that calculation are less common, but they do happen. And if your benefit was supposed to reflect 3 or 4 years of delayed credits and it does not, you are leaving real money unclaimed. When you log into your My Social Security account, you can see the benefit estimate broken down. If the math does not match what you were told or what you expected, that is worth a phone call. In May of this year, a report from a government oversight office confirmed that thousands of widows and widowers had been underpaid due to a calculation error involving a process called the Widows Indexing Computation. The SSA itself acknowledged the problem. Those people did not do anything wrong. They filed correctly, they waited the right amount of time, and the math inside the SSA's own system was applied incorrectly during a manual processing step. The Inspector General estimated that roughly 40% of surviving spouses reviewed during that period may have been affected by similar errors. 40%. That is not a rounding error. That is a systemic problem that the government quietly acknowledges when pressed, but does not go out of its way to publicize. This is the part I want to stay with you after this video is over. The Social Security Administration is not your adversary. Most of the people who work there are trying to do their jobs. But the system is enormous, it is complex, it was built on decades of paper records and manual entries. And the honest reality is that it makes mistakes that cost real people real money. The burden of catching those mistakes does not fall on the SSA. It falls on you. And the only way you catch them is by looking. If you were born before 1955, your full retirement age was 66. Your benefit was supposed to be calculated on your 35 highest earning years, correctly recorded and correctly indexed. Before you close this video, go to ssa.gov, log into your My Social Security account, and look at your earnings history. All of it. Every year going back to the beginning. If you see something that does not look right, it probably is not. The form to fix it is SSA-7008, and the number to call is 1-800-772-1213. Send this video to one person you love who was born before 1955 and is collecting Social Security right now. One share takes 10 seconds. If their earnings record has even one missing year, finding it could put over $1,000 a year back into their account permanently. Money the SSA has been calculating wrong without sending a single letter to tell them about it. That is what this channel is here to do. I will see you in the next one. The federal government has been withholding money from 3.2 million Americans for 43 years. The average amount withheld $480 a month, every single month, for the rest of their retirement. 800,000 widows and widowers in this country had their entire survivor benefit eliminated completely, not reduced, gone, because of two rules buried deep inside the Social Security Code that almost nobody knew existed. Those rules are now gone. The Social Security Fairness Act was signed into law in January 2025 and eliminated both of them permanently. The back payments are sitting in the system right now. The average check is $6,710. Some people are owed over $22,000, but SSA is not calling. SSA is not sending letters, and thousands of people in the affected group still have not received a single dollar. Today I am going to tell you exactly what these two rules were, who they affected, how much money is owed, and the 3 steps that determine whether that money gets deposited into your account or sits in a federal processing queue until you stop checking. Stay until the end. The 3rd step is the one almost nobody takes, and it is the only step that gets widows and widowers the full amount they are owed. If you are not subscribed yet, do that right now and turn on the bell. Social Security rules change every single year. When they change, nobody explains what it means for your specific situation. That is exactly what this channel does. Subscribe and let's get into it. For 43 years, the Social Security Administration used 2 separate rules to reduce or eliminate benefits for millions of Americans. Most of the people affected had no idea either rule existed until they went to claim their benefit and got a number far smaller than what they expected. Some got 0. Rule 1 was called the windfall elimination provision. Here is who it targeted. If you worked in a job that had its own pension system, a public sector job that did not withhold Social Security taxes from your paycheck, and you also worked other jobs in your lifetime that did pay into Social Security, the WEP formula slashed your Social Security check. It did not eliminate it. It reduced it using a modified benefit calculation that treated your Social Security earnings as worth less than they actually were. The more years you spent in the non-covered pension job, the bigger the cut. The average monthly reduction under WEP was $480. Some people lost as much as $587 a month. That reduction was permanent. It never adjusted back. Every single month for the rest of their retirement, they collected less than they earned. Over 3.2 million people were affected by this rule alone. Rule 2 was called the government pension offset. This one went after spouses and widows specifically. If you were entitled to a spousal benefit or a survivor benefit based on your husband or wife's Social Security record, and you also received a government pension from a job that did not pay into Social Security GPO, reduce that benefit by 2/3 of your pension amount. Here is what that looked like in real numbers. Say your government pension was $1,500 a month. 2/3 of that is $1,000. GPO subtracted $1,000 from your spousal or survivor benefit. If that benefit was $900, the subtraction wiped it out entirely. You received 0. Nothing from your spouse's record. Nothing from decades of your husband or wife paying into a system that was supposed to protect you if something happened to them. 800,000 widows and widowers lost their entire survivor benefit this way. Not a reduction, a complete elimination. Now stop and think about this number. Over a 40-year period, Congress introduced 300 separate bills to repeal these 2 rules. 300. Members of both parties kept introducing legislation. Teachers' unions, firefighter associations, federal employee organizations lobbied every single session. They testified at hearings. They sent thousands of letters. They showed up at congressional offices year after year. Not one bill passed. For 4 decades, 3.2 million Americans kept having their checks cut.
800,000 widows kept losing their entire survivor benefit, and every year Congress moved on to other business until January 5th, 2025. The Social Security Fairness Act was signed into law on January 5th, 2025. Both rules, WEP and GPO, were eliminated completely, not reduced, not phased out over 5 years, gone, and the law was made retroactive to January 2024. That means SSA owes every single affected person the difference between what they received and what they should have received going all the way back to January 2024. A minimum of 12 months of back payments. Paid as a single lump sum, direct deposited, SSA began processing and issuing corrections throughout 2025. The average retroactive lump sum payment issued so far is $6,710. The average permanent monthly benefit increase is $360. That is $4,320 more per year, every year, for the rest of their retirement. For people whose entire survivor benefit was eliminated by GPO, the retroactive payment is significantly higher. A survivor benefit of $1,840 a month that was fully erased by GPO means a back payment of over $22,000 covering January 2024 forward. Plus that full benefit, reinstated every single month going forward, the total estimated value of all corrections owed under this law is $196 billion over the next 10 years. That number came from the Congressional Budget Office, $196 billion sitting in the system that belongs to people who earned it. Here is the problem. Not everyone has received their correction. SSA has over 4 million individual account adjustments to process. They are working through them in batches. When your case falls to the bottom of a processing batch, it waits, sometimes for months, while you keep collecting the old reduced amount with no letter from SSA and no explanation. The SSA Inspector General flagged this as a significant concern in 2025 reporting. That is bureaucratic language for a substantial number of people have not received their full correction and have no way of knowing it. There are people right now in 2026 whose monthly benefit has still not been adjusted. There are people who received a one-time retroactive payment, but whose ongoing monthly amount is still running on the old reduced formula. And there are people who qualified for corrections under both WEP and GPO, but only had one of them applied to their record. SSA is not going to flag your own case for you. The corrections that are not challenged stay uncorrected. The money that is not claimed does not accrue interest. It does not carry forward. It sits. If you have not logged into your Social Security account and specifically checked your benefit amount since January 2025, you do not know whether your correction was applied or not. 4 groups are affected. Listen for yours. Group 1. You worked as a public school teacher, especially in these states: Alaska, California, Colorado, Connecticut, Georgia, Illinois, Kentucky, Louisiana, Maine, Massachusetts, Missouri, Nevada, Ohio, Rhode Island, or Texas. And at some point in your working life, you also worked other jobs where you paid into Social Security. Group 2, you worked as a firefighter, police officer, or any state or local government employee in those same states. And you also paid into Social Security through other employment at any point in your career. Group 3, you are a federal employee who was hired before January 1st, 1984, and you were enrolled in the Civil Service Retirement System, CSRS, not FERS, CSRS. If you do not know which system you were under, check your old federal benefits paperwork or call your former agency's HR office directly. Group 4, you are a widow or widower whose spousal or survivor benefit was either reduced or eliminated entirely because you receive a government pension. If you fall into any one of those 4 groups, this law applies to you directly. A back payment may be sitting on your account right now uncollected. Here's exactly what to do. 3 steps. Step 1. Go to ssa.gov and log into your My Social Security account. If you do not have one, create it. You will need your Social Security number and a valid email address, and it takes about 10 minutes. Once you are logged in, open your benefit statement. Look at your current monthly benefit amount. Then look specifically for any line that says WEP or GPO. If you see a reduction listed there and your monthly benefit has not gone up since January 2025, your correction is not complete. Your case is still sitting in the queue. Step 2. Call the Social Security Administration directly. The number is 1-800-772-1213. When an agent answers, use these exact words. I want to verify whether my account has been fully corrected under the Social Security Fairness Act for WEP or GPO. Write that sentence down before you dial. That specific language tells the agent exactly which system to open and which correction history to pull. They will tell you immediately whether your case is closed, pending, or has not yet been assigned. If it is pending, ask for the expected processing date and ask them to note that you called to follow up. If they say it is closed and you believe the monthly amount is still wrong, say these exact words. I would like to file a formal request for reconsideration. That phrase triggers a supervisor-level review, not just a standard callback, a separate review of your entire correction record. Step 3 is specifically for widows and widowers. And this is the step that determines whether you receive the full back payment or receive nothing. If your survivor benefit was not just reduced but eliminated completely by GPO, do not assume the correction happened automatically when the law passed. Some GPO cases require a completely new survivor benefit application. Because the original application was denied outright, not reduced, denied, the system has no approved claim to reverse. It cannot correct what it never approved in the first place. You have to reapply. When you call SSA, ask this exact question. Does my case require a new survivor benefit application under the Social Security Fairness Act? That one question is the difference between collecting your back payment and watching it expire in the system unclaimed. The government withheld money from 3.2 million Americans for 43 years using two rules most of those people never knew existed. The rules are gone now. The back payments are real. The average check is $6,710. Some people are owed over $22,000. SSA is not calling. SSA is not sending letters. The only way this money moves from the system into your account is if you take one of the 3 steps I just walked through. Send this video to one person you love who is over 60 and collecting Social Security right now. That one share might put $6,710 in their account. Money the Social Security Administration has been holding since January 2024 without sending a single letter to tell them it exists. That is what this channel is here to do. I will see you in the next.
Meet Robert. He's a smart guy, a retired structural engineer who planned his retirement down to the penny. When he turned 62 last year, he did what millions of Americans do. He logged onto the government website and claimed his Social Security early. His full benefit would have been $2,500 a month if he waited until 67, but by filing early, he accepted a permanent 30% reduction, leaving him with a monthly check of $1,750. He thought he was locked in for life. But within months, property taxes jumped, inflation soared, and Robert realized he had made a massive mistake that was going to cost him his lifestyle. What he didn't know, and what 99% of retirees have absolutely no clue about, is that the system has a hidden escape hatch. It is a legal, completely official government do-over button that lets you completely erase your early filing penalty and reset your checks to their maximum potential. If you want to know exactly how to trigger this loophole before your deadline runs out, hit subscribe and turn on the bell. Social Security rules, loophole deadlines, and benefit procedures change every single year. When they change, nobody from the government explains how to reverse a massive financial mistake or how to save your retirement after you have already signed the paperwork. That is exactly what this channel does. Now let's look at the exact document Robert used to fix his mistake. This strategy revolves around a specific government document called Form SSA-521, officially known as a request for withdrawal of application. You will not see this form advertised on television, and you almost certainly will not hear a government clerk bring it up unless you specifically ask for it by name. To understand why this form is so powerful, you have to understand how Social Security views your retirement decision. When you claim early, you are making a binding contract. The government agrees to pay you earlier, but in exchange, they penalize you every single month for the rest of your life. For someone like Robert, that 30% penalty does not just hurt today, it compounds over time. Every cost of living adjustment, every inflation bump is calculated based on that smaller foundational number. If Robert lives into his mid-80s, that single decision at age 62 could easily cost him over $100,000 in lost lifetime income.
That is a terrifying amount of money to leave on the table simply because of panic or a slight miscalculation. But Form SSA 521 changes the rules of the game. Filing this form tells the government that you have changed your mind. You are legally withdrawing your application for benefits. If approved, the administration treats your record as if you had never filed in the first place. Your early claiming penalty is entirely erased. Your benefit amount is free to start growing again, gaining those crucial delayed retirement credits up to 8% per year until it reaches its absolute maximum at age 70. It is the ultimate financial time machine. But as you might expect when dealing with massive government bureaucracies and hundreds of thousands of dollars, this time machine comes with a very serious catch. You cannot just casually decide to undo your retirement years down the road when you feel like it. The Social Security Administration has put 3 rigid, uncompromising rules in place to prevent people from abusing this system. If you want to pull this off, you have to navigate these rules perfectly. The first rule is the time limit, and it is the reason why urgency is everything. You only have 12 months from the exact date your benefits were first approved to file Form SSA-521. This is a hard deadline. It is not 12 months from the end of the year, and it is not 12 months from when you decide you made a mistake. It is exactly 1 year from your approval date. If you wake up on day 366 and realize your checks are too small, this specific door is slammed shut forever. This 12-month window is designed for people like Robert, people who claimed early out of fear or temporary necessity, but quickly realized within their first year of retirement that they made a miscalculation. Maybe they inherited some money, maybe they decided to go back to work because they were bored, or maybe they simply sat down with a calculator and realized the math of early claiming was destroying their long-term security. Whatever the reason, you have to act fast. The second rule is the most daunting one, and it is the step where most people get scared away. The government will gladly let you wipe your slate clean and reset your benefits, but they are not going to let you keep the money they already gave you. You have to pay back every single penny. It is like putting toothpaste back into the tube. But here's the critical detail that catches even smart people off guard. You do not just pay back the amount that was deposited into your bank account. You have to pay back the gross amount. Let us look at Robert again. For 11 months, his gross benefit was $1,750, but his actual bank deposit was smaller because the government was deducting his Medicare Part B premiums directly from his check. Let us say those premiums were around $175 a month. That means Robert was only seeing $1,575 hit his checking account. When he files his withdrawal application, he cannot just write a check for the money he actually received. He has to write a check for the full gross amount, which includes reimbursing the system for all those Medicare premiums, any voluntary tax withholdings he might have set up, and even garnishments if he had any. For Robert, 11 months multiplied by his gross benefit of $1,750 means he has to write a single lump sum check for $19,250. And the repayment rule goes even deeper than your own pockets. If anyone else in your family is claiming benefits based on your earning record, they have to pay their money back too. Let us say Robert had a younger wife who was collecting a spousal benefit off of his record during those same 11 months. In order for Robert to reset his own benefits, his wife also has to agree in writing to the withdrawal, and every single dollar she received as a spousal benefit must also be repaid in full. If you cannot afford to pay back the gross amount, plus the Medicare deductions, plus the taxes, plus any spousal benefits, the government will deny your request, and you will remain locked into your reduced payments for life. The third rule is simple but absolute. This is a one-time offer. You get exactly one do-over in your lifetime. If you file the paperwork, write the massive repayment check, and reset your benefits, you can certainly reapply for Social Security a few years later when you are older. But if you change your mind a second time, you are out of luck. The government will not let you use the withdrawal strategy again. It is a one-and-done emergency cord. So what happens if you are listening to this and your heart sinks because you claimed your benefits 3 years ago? You have missed the 12-month window. You are disqualified from using the withdrawal of application strategy. Are you completely doomed to suffer the permanent penalty? This brings us to the backup plan, a completely different strategy that operates under a different set of rules. It is not quite a time machine, but it is an incredibly powerful tool to stop the bleeding and force your checks to grow. And this strategy is called voluntary suspension. Voluntary suspension is designed for people who miss the one-year do-over window but still want to increase their future monthly payouts. Here's how it works. Once you reach your full retirement age, which is 67 for anyone born in 1960 or later, you have the legal right to ask the Social Security Administration to simply stop sending you checks. You tell them to pause your payments. Why would you ever ask the government to stop paying you? Because of a magical mechanism called delayed retirement credits. For every single month that you suspend your benefits between your full retirement age and age 70, your underlying benefit amount grows by 2/3 of 1%. That adds up to a guaranteed 8% return on your money every single year. Let us imagine a different version of Robert. Let us say he claimed at 62, but he did not realize his mistake until he was 65. The 12-month window for the full do-over is long gone. He feels stuck. He continues to collect his reduced checks of $1,750. But then his 67th birthday arrives. He has reached full retirement age. He contacts the administration and requests a voluntary suspension. Immediately, his monthly checks stop. But he does not have to pay back a single dime of the money he collected over the past 5 years. That money is his to keep. Instead, his benefit just sits there, frozen, but growing. He leaves it suspended for 3 years until he turns 70. Because of the 8% annual growth, his benefit increases by a total of 24%. When he turns his benefits back on at age 70, his monthly check jumps from $1,750 up to $2,170. He essentially manufactured over $400 of extra guaranteed monthly income for the rest of his life, simply by utilizing the pause button at the correct time. Just like the full withdrawal strategy, voluntary suspension has its own strict nuances that you must plan around. The most critical factor is how it affects your family. When you voluntarily suspend your own retirement benefits, the government automatically suspends any secondary benefits that are being paid out based on your record. If your spouse is relying on a spousal benefit derived from your earnings, their checks will also stop completely during the exact same months your checks are paused. The only exception to this rule is for divorced spouses. If you have an ex-spouse claiming on your record, your decision to suspend will not interrupt their payments. But for your current household, a voluntary suspension means a complete halt to that income stream. You have to be absolutely certain you have enough outside savings, a pension, or part-time income to bridge the gap. During those years, your checks are paused. Furthermore, if you suspend your benefits, the government can no longer automatically deduct your Medicare Part B premiums from your checks. The premiums do not go away. You just become responsible for paying them directly out of pocket. If you forget to set up a direct payment plan for your Medicare premiums while your Social Security is suspended, you could find yourself unexpectedly losing your health coverage, which is a disaster no senior should ever face. Both of these strategies, the full withdrawal of application within the first 12 months and the voluntary suspension at full retirement age, are deeply complex maneuvers. They require you to look brutally honestly at your life expectancy, your current cash reserves, and your tax situation. But they prove one fundamental truth about retirement planning. The system is not a black box that you are entirely helpless against. Yes, the rules are bureaucratic, and yes, the penalties for ignorance are severe. But the tools exist to course correct. Whether you are 11 months into retirement and realizing you need to hit the emergency reset button, or you are approaching full retirement age and looking for a way to give your fixed income a massive final boost, the power is actually in your hands. You just have to know the forms to ask for, the deadlines to respect, and the exact mathematical cost of changing your mind. It is your money, your history of hard work, and your future. Take the time to run your own numbers. Sit down with a fiduciary if you need to, And never assume that your first decision has to be your final one. Send this video to one person you love who claimed their Social Security early or is approaching retirement right now. One share takes 10 seconds. Also, please hit that like button so the algorithm shows this to other seniors who might be trapped with smaller checks. If they are regretting their decision, finding out about this legal do-over option or the suspension strategy could put hundreds of dollars a month back into their household permanently. Money the government will keep unless someone tells them which form to use. That is what this channel is here to do. I will see you in the next one.